thanks for joining us. I'm so excited that I have one of my favorite lender partners with us today. Kim Sechrest with American Mortgage is here with me. Kim is going to discuss how the low interest rates and options and what options we have available to us in this marketplace right now. It's a very fluid industry and choices and timing can be confusing. So it's incredibly important to have a knowledgeable loan expert to help you navigate the process. So I have 3 goals for today. The first one is to introduce you to Kim Sechrest so that you'll have her as a resource to help you with all of your loan and mortgage needs. 2, I want to show off this beautiful home that we're showcasing today and find a perfect buyer for it. And 3, I want to discuss financing options, interest rates, etc., to help everyone understand what opportunities are available. So whether you're looking to buy a house or whether you're thinking about taking advantage of the low interest environment to refinance, we're going to talk about all of that. So first, let me introduce Kim. I've worked with Kim over the past couple of years with many transactions, and she is amazing. So in learning and understanding how Kim operates and getting to know her more, I've come up with a special little slogan for Kim. If there's a will, Kim will find a way. So sometimes the transactions can be almost seem like they're impossible. Like there's a situation that arises that we think we can't do this isn't going to happen. And whenever that happens, when I've got Kim involved in the transaction, I know we're going to figure out how to get through it. So she is amazing. And not only is she an expert in her field, she also genuinely cares about everyone she works with. And that's why she's so good at solving problems. She doesn't give up. She figures it out. So I am excited to have Kim on this call to share her knowledge and insights with us today. And to start out, Kim, your company, American Mortgage, is a mortgage broker, meaning that your office offers a variety of lenders and mortgage solutions, correct?
Yes, and Ruth, thank you so much for the kind words. I really appreciate it. I love working with you too. It's awesome. We get it done. We make a great team. But yes, we are mortgage brokers. And basically what that means is that instead of working with one particular lender, we work with several. So we have a lot of different options.
Awesome. So can you tell us a bit more about what does this type of structure look like? What are the advantages? How is it different than going to the local bank?
So basically, when you're looking at a local bank or a correspondent, what we call a correspondent lender, you're looking at a very inside the box kind of what I call vanilla lending. And it's your typical USDA, FHA, conventional VA financing, which we all have, but we do allow things a little bit outside the box. So we have several different lenders that have different overlays. For example, right now, everybody's hearing the word 640 for a credit score minimum with the coronavirus, but we do actually have some lenders that will go down to a 580. Now, are they easy? You know, not necessarily easy to do, but we do have that option available. So when you're working with a broker, you're not just working with one bank. So we really get to know our underwriters well. We know our lenders well. We know what they're going to take and what they're not going to take, and so we have more flexibility, in my opinion.
Okay, good. That's awesome. So Kim, we're at this house today that is in Black Diamond Ranch. It's a 4-bedroom, 4-bath home. So this is a large house. And so I've identified some specific buyers that I think would be perfect for this house, meaning the demographics of the specific buyer. So I want to talk about that, and I want you to share, as I share with you who I think is perfect for this house, you tell me what solutions might be really good for these particular buyers. So I have 3 different types. The first one would be, of course, the large family. So with 4 bedrooms and 4 full baths, and the bedrooms all have their own ensuite bathroom. The one that would serve as a guest bathroom and ensuite is a Jack and Jill setup. But because they're all suites, I think of a family that maybe has a couple of teenagers, you know, that want their private little space and such. All of the guest bedrooms are down a separate hallway. So it is a split bedroom plan, although the master is not on the other side of the house, but it does have a very private hallway. So the large family would be one. Another one would be the winter resident. who's going to come down to Florida and spend, 3-4 months here. And of course, then they're going to have extended family that want to come stay with them, the kids, the grandkids, maybe friends as well. And so this house offers plenty of space to do that. And the third one I have in mind, which is a little bit different, is I run across from time to time couples, unrelated, that like to vacation together. And so then at some point in time, they get there, oh, we're always coming to Florida. We need to find a place and purchase it together. So you could potentially take 3 or 4 couples and allow them to go into the purchase together, and then all have use, almost like creating your own timeshare. So those are kind of the 3 things that I thought might be a neat fit for this house. So can we just break those down one at a time? Would that be okay?
Sure, absolutely. So to start off, the large family.
Perfect.
I would suggest they would really qualify for all of the regular programs available: conventional, FHA, VA, and USDA. Yes, that house is a USDA eligible house with 0% down. So they could, and it would be nice because then they can use that money to do whatever they want, buy some pool toys and have fun in those suites and enjoy that house. But depending on the down payment and the credit profile, they will qualify for all 4 of those programs for that house. And all of them are great. USDA 0 down. Yep.
Did you froze up for a second there on my end, but did you say no down payment for a USDA loan?
Yes, USDA is 0 down. And believe it or not, I actually have closed a couple in Black Diamond on the USDA program. So it's a really excellent program, especially for families. Mm-hmm.
So one of the neat things then that I'll share with you is if someone fits that scenario well, that USDA would be a good vehicle for them and keep more money in their pocket. This is a very motivated seller. This house is completely remodeled, so it's move-in ready, and the seller's motivated. So I do think that they could also potentially ask for closing costs, right? And then not have any money out of pocket.
Pretty much, except for inspections, appraisal, and yeah, they could easily get into that house for 0 down.
Wow.
Truly 0.
That's pretty awesome.
It's a great program. It really is. It's an amazing program.
So while we're on that topic of the large family buyer, can you tell me, this house is listed for $299,900. What kind of income scenarios would we need in order, debt to income ratios, those types of things, to qualify for this house?
So everybody's different, and every program's different. So to really say what kind of income, we couldn't really tell you the income because it depends on their debt load. If they have a small debt load, obviously they would need a smaller income. If they have a larger debt load, they would need a larger income. However, USDA does like to cap the ratios at a 41% back end, 29% front end. And what that means is the new house payment in relation to what the gross income is monthly, they don't like it to go over 29%. And then what we call the back end ratio is with the new house payment plus the existing debt load. They don't like that to go over 41% of what the gross income is per month. And we do go by gross income, unless you're self-employed, then we go by the adjusted net. So
in other words, I'm looking at not my after-tax income, but the salary that my employer says I receive, correct, even though I don't get that in my pocket.
Correct.
And then I'm calculating my 29% off of that to determine, correct, what can I afford. Now, explain to me, I didn't quite follow you on the 29% versus the 41%. When does the 41 kick in versus using the 29?
So the 29 is just the new house payment in relation to the gross income. The 41 is the new house payment plus all the existing debt. So any car notes, student loan notes, credit cards, the minimum monthly payments on that, we combine that all into one monthly payment, and then that actually goes towards the 41%.
Okay, so on the 29% side, you would only be using that calculation if you had no other debt?
Yeah.
Okay.
If there was no other debt, it would be, we use both. So say, for example, somebody has a house payment, excuse me, say their back end is 41%, but we remove the house payment and that house payment is actually 35% of their gross income, they would not qualify for a USDA loan because it has to be 29% or
I
less.
see. Okay,
Mhm.
that makes sense now.
Yeah.
Okay. All right. So the easiest thing for someone to do though would be to just figure out what are the debts that we're paying on. So we're talking about car loans, we're talking about individual, private loans of whatever sort. We're talking about credit card,
Yes.
minimum payments, all of those things. Total that up,
Correct.
and then figure out what gap you have in the 41%, and that's what you could potentially afford. Just as an easy calculation, I guess.
As an easy calculation, yeah. I mean, does USDA make some exceptions with a certain credit score? They do, but they really don't go over 43%. So, yeah.
Well, this other question just popped into my head, and I think it's something it comes up from time to time. So I want to ask you, when you have a couple, oftentimes the couple has two different credit scores, right? Each person has a credit score. And so are there scenarios where only one should be used for the actual qualifying for the loan to get the best rates, but then you can still take the whole household income into play, or how does that work?
So that's a loaded question because everybody has three credit scores. When there's a couple, we take the lowest middle. So if one person has 650, 640, 630, that 640 is theirs. Let's say their spouse has a 720, a 730, and a 740. That 720 is theirs, but we're still going to go by that six figure, the six number, by that 630, because I take the lowest middle two. So as a broker, we're gonna analyze each person individually, and it might make sense to take that other person off the loan, keep them on title, and do it that way. However, USDA is a little different. The way it works is in normal loans like FHA, VA, conventional, we can do that and not have to count the spouse's income. But on a USDA loan, you kind of qualify in two ways. You qualify for the ratio, but then USDA has an income limit depending on your family size. And everybody that's making money in that household has to go towards that income limit. So there's a couple of different qualifying factors in that. So they may have the spouse off and it may be great and they're just in that limit, but then we do have to count the other spouse's income as well, and that may push them over a little bit. So,
I see. Interesting.
Yeah.
Okay. Lots of strategies. Again, why I think it's really important to have a knowledgeable loan expert to help you.
Yes, no matter who you're working with, it's very important that you speak with your loan officer, be upfront, honest, and talk to them and tell them everything. It's their job to help you get your loan and the best product for you.
Mm-hmm. Okay,
Yeah.
Great. So let's go to the next one then. What about our winter second home buyer?
So the winter second home buyer is probably going to be your best bet on a conventional loan. As a second home, 10% down. The conventionals are 10% down for second home, and it's going to be your standard vanilla product, Fannie Mae and Freddie Mac. They don't like to go over a 45% total ratio on the back. The front end is a little tricky because I'll be honest with you, it's just pretty much, they have your standard 31%, but there's a lot of times, depending if the borrower is really strong and they have reserves or really great credit score, we can really push that and play with it a little bit. Yeah.
Okay, good. Great. So that leaves us then with the most unique scenario of the unrelated couples.
Yes.
Can I start thinking about what friends I want to invite to buy this house with me?
I want to invite friends to buy the house. It sounds really cool. So yeah, that's going to be your standard investor loan where everybody is going to be on title. It's a 20% down conventional loan, basically. And the same applies. However, everybody's income and everybody's debts are kind of combined to get those ratios. So
is there any limitation to how many people can be a party to the transaction or anything like that?
It really isn't, but however, the lenders really don't like to see more than 3 or 4. That's pretty much what our lenders have. Every lender has an overlay, is what we call it. So we may have our guidelines, but each lender has their own specific set of rules on top of that they like to stick to. And I think the most I've ever gotten through has been 3 or 4.
Okay. How often do you run into that type of scenario?
I don't run into it often. No, okay. I run into more of a situation where, it's a first-time home buyer, maybe a young person just out of college and their parents are co-signing for them. So that's something I've run into a lot. But we don't run into like 3 or 4 people buying a house at the same time.
I literally
Not
just
often.
had a conversation with some buyers recently that's what they're looking to do. So that's why, as I was thinking about this house and all the different ways you could use it, I thought, boy, this would be one that would work well. So,
Yeah, when I have a situation like that, we usually pick like the top 2 or 3 strongest buyers, but then everybody will go on title. So they
okay,
all have a stake in it, and then they can, you know, still be a part of ownership. But 2 or 3 of them actually hold the note.
gotcha. Okay. So another thing that makes, I think comes to mind, and I think people would probably question too, when we talk about the affordability of this home and what type of income you need and those qualification factors. This is in Black Diamond Ranch, so it does have a little bit higher HOA fee than a lot of our surrounding communities. So it's $567 per quarter. So you're looking at a little over $2,000 a year on your HOA. How does that affect the income, the debt to income ratios and things that you're looking at?
So when you're talking about HOA dues, basically we prorate it on a monthly basis, and we put it in that calculation as if it was a monthly payment, and it is calculated in the debt to income ratio. However, even saying that HOA, I've seen a lot. It's really, it's not good for, you get a lot. You're in a really nice community, so it's just something to consider. It's not paid in your monthly payment. However, you will see it broken down on a monthly basis, and that's how we calculate it, because we do have to take in consideration the HOA dues.
Okay, gotcha. All right. So trying to think what else I know what I wanted to ask you about. So not related to this house, but something that I know is heavy. I'm getting this question very frequently, is with the low interest rate environment that we have right now. How do people determine, does it make sense to try and refinance? And what are we looking at right now for interest rates?
So interest rates is, and I get it all the time. I saw this rate published, I saw this rate, and I'm like, that's great, but it may not be for you. It's like going to the doctor and saying, I want penicillin, and you don't even know what you have. So basically, it's everybody is unique. Interest rates are a combination of the type of loan you do, the down payment, the credit score, the type of property. Believe it or not, manufactured homes are a little higher, condos are a little higher. And the debt ratio. So there's a whole combination that goes into rates. And the great thing about being the broker is we shop them. So we don't just have like one set standard. And also in our business, we're a little more flexible to be able to help the buyers out a little bit more when it comes to rate versus some of the other companies that, they have the corporate structure that they can't really have that flexibility. But rates are a tricky thing right now. So we're in some different times. I don't think I've ever lended in a pandemic before, but it's been an adjustment. However, rates are still amazingly low, and they're still great. I remember when I first bought my first home, it was 7%, and I thought, yeah, I was a mortgage broker. I got the best rate. It was awesome. And now if I was to ever say 7%, people would just be like, what? So it's rates are really good right now. And again, it really depends on your individual profile on how we can come up with the best rate. And then for refinancing, absolutely, it makes sense to refinance depending on what you're at now. But if it doesn't, we're going to be honest with you and say, hey, this is just not right for you at the moment. And we'll take it from there. But everybody's different when it comes to rates.
So Kim, if a customer reaches out to you curious about the opportunity to refinance and maybe it's not the right time for them, are you keeping them to follow up with in your database to say, hey, now things look pretty good, now would be a good time to do it?
Absolutely. So we have one person strictly dedicated because of the crazy rate environment right now. We have one person just literally watching rates because we do work with a lot of lenders. So it's hard to keep up with them individually. So we have one person that does it, sends our announcement out, hey, rates are good here, whatever loans we have. I actually have a list right now going on for people that it just doesn't make sense. But the minute we see that go to a certain percent, we're jumping on them and we're letting them know. So absolutely, because the beginning of March was probably the lowest I've seen them go, where I was locking FHAs in the 2s. But I do believe it's going to come back, probably not as quickly as I would like, but I do believe we're going to see it again. So
I can just see you jumping out of the bushes, pouncing on people. The rates are
I
going.
know. Well, you know me.
That's
I
great.
have that energy anyway. Probably scare people, but still, I do. You know, like I said, there's a lot of people kind of just waiting, and
Yeah.
you know, and not to say that it's not happening now. We do have dips, and sometimes, you know, they'll dip down, and we'll jump on them real quick and get as many in as we can while we can. So
That's awesome. That's really valuable because you're the front line. You see it. You see the changes as they're happening. Whereas the rest of us, it's like, hey, it looks good, and then we call, oops, that was yesterday. You know, that was an hour
yeah.
ago. You missed it. So that I love to hear that you can keep people informed. And there was another question I had around that, and it has just jumped right out of my head. Um, Oh, I know what it was. Okay, so this always plagues me a little bit. And the question is, are there qualifying questions that you ask someone or that a person, an individual should ask themselves to determine if refinancing, of course, there's a cost that is involved with refinancing your home. And so you have to be cognizant of that cost in connection to what are your future plans. So do you
Yes.
have a recommendation? Like if someone says, well, I'm probably only going to live in this home for 2 more years, that's probably not long enough to benefit from a refinance versus, you know, what would those considerations be?
So probably the first question I do ask everybody is, how long do you plan on being in this home?
Okay.
So at the end of the day, you know, if you're just going to try, excuse me, and lower your rate, and you're only going to be there a year or two, it may not be beneficial to refinance. However, there's so many other things you can do with a refinance. For example, if you have a lot of revolving debt, you know, paying that off on a low interest rate refinance might be worth it. You can be surprised how much you can save monthly just by doing that. If you're looking to make home improvements to possibly sell your home and you don't have the liquid cash right now, that's a good, you know, and you are moving in 2 years, well, then it may be beneficial to go ahead and get that cash out at a very low interest rate. And then, you know, you'll make up for it because your improvements are going to sell your house for more money. So there's a lot of different scenarios, but if they're only going to be there and they just want to strictly lower the rate, maybe a year or two, then we have to dig a little deeper and see if it's really going to be worth it for them.
Okay. And you know, the one I love, Kim, is if you use the refinance, say, to pay off other debts, or even if you just use it to lower your payment, but then you're disciplined enough to say, but I'm going to make the same payment I was making before. And so now I can escalate my equity growth in my home. That's a beautiful thing. And then every
It
time you
is.
see your statement, you see that happening, you feel really good about it.
Yeah, so mortgages are crazy, but I always tell everybody at the closing table, and this is probably common knowledge, but I'm going to say it again, that if you make one of your payments extra a year and put it all towards principal, it knocks out 8 years of your mortgage. Just one extra payment every year. So
Amazing.
if you made two, could you imagine what you did? So, you know, and that's another thing I guide people when they're like, I want a 15-year, I want a 15-year. I'm like, hey, we don't know if another pandemic's coming, and you don't know if you're going to have a job. Stick with the
Exactly.
30-year. Pay it
Yep.
off. You
Yep.
know, it's, you know, unless you know
Flexibility.
hands down,
Yeah.
it just gives you that flexible payment. So
Yep. That's great. Oh, I love that. I love that you have those conversations with people. That's so great. I don't think I don't know, but you're the best in my opinion. But I think there's a lot of lenders that just go through the paces, right? They just check the boxes and they just get the loan done, but they're not consulting or, you know, helping the customer. So that's really valuable.
well, thank you.
Um, all right, so let me see what else, if there's anything else I had as far, I know the final question I want to ask you, but let me ask one more first.
Sure.
So this may not be worded right, but what are the best practices for pre-approval and speak to the whole, so how do you position yourself the best from the pre-approval standpoint? What should you be prepared for to get that full pre-approval? And then what do we need to know about locking in the rate? How does that work? When do the rates expire? Those types of things.
Okay, so pre-approval, hands down, before you even looking at a house, you need to have a pre-approval, because especially in this lending climate right now with what we're going through, a lot of lenders, just the guidelines have changed on a daily basis at this point. So So basically, you just want to make sure you are fully pre-approved. Having the conversation, I like to have what we call our hopes and dreams call, which is where I basically interview everybody and just kind of find out what they're looking for and what their goal is in their mortgage loan. And so then we move to the second process. That's basically just a pre-qual where I'm just having a conversation. I look and I say, hey, they could probably qualify for this. But at the end of the day, to get that full pre-approval, we do need to see the credit profile. I like to verify the income. I like to have it all up front. This way, when we have a property, it's plug and play and we can just go. So the next step would be for them to apply and actually gather their income documents. And I have a whole email I send out with them with a checklist that they can do. And we need all income, bank statements is where we get everything up front and we do it. And then it doesn't take us long, a couple of hours, depending on the time of day, and we can run it through and we actually have a full pre-approval. And that is good buying power because we can actually tell the listing agent that, hey, this person's income's been verified, their credit's been verified. They have been run through the automated system already, and we have the essential approval, and we just need to do the verifications at this point with the lender. So it's a huge advantage. It's a huge advantage.
Yeah, sounds like it. So they're positioned as a stronger buyer, but then not
Yes.
only that, they have the full confidence of knowing this was not just our little telephone call that said, yeah, you qualify. This is actually, we've completely vetted all your stuff and we know you're good to go.
Yes, and not your 8-minute quick approval.
Right. Go ahead.
Get pre-approved in 8 minutes. No, it doesn't work that way.
Right. Oh, that's awesome. Good to know. So I guess the final question would be, are there any tips or what would be the one tip that you would give people out there that are looking to buy a house that say, I guess based on maybe mistakes, no one that I associate with would ever make any mistakes, but for our friend, we're asking for a friend. If there was a mistake.
Oh my gosh. Definitely keep an eye on your credit. That's probably first and foremost right now. Credit is king. So you definitely want to try and do something with the credit. Working with a lot of people right now where the credit's just not there, but we're working with them to get them there. And then another thing, and this is kind of a little quirky thing, but I'm just running into it a lot lately, but if you are currently paying rent, do not use cash because we can't verify it. So I say if you're paying rent, pay with a check as much as you can. I know it's old school, but it's the easiest way to verify rental income when you're paying to a private landlord. I'm not talking like an apartment complex or a management company, but there's a lot of people out there that are paying to a private landlord, and sometimes the loan calls for a verification of rent, especially on the USDA. That happens a lot, and we can't verify it. So that's key, I would think that. And then basically really just stay on your credit, because if you have good credit, we can overcome a lot of the other obstacles in the way.
So are you saying on the rent verification, so if I'm paying rent to an individual landlord and you come and ask me for verification of my rent payments, I paid them cash, but I would think most of them use some sort of accounting system to keep track of things. And if they do, if they could print out like a QuickBooks ledger that shows all my payments, does that suffice? Or
we would need your actual bank statement showing the same amount withdrawn. It's very tricky to verify cash payments. Yeah.
It has to come from me, in other words, showing that this money left my account and came to you, not.
Yeah, I would do both. I would kind of like make it like I would connect the dots for the lender, and I would also get the verification from them as well, and kind of just make my case to them, because on individuals, when you're paying an individual, they really want to see it hands down that you're paying that individual. And just playing devil's advocate, it could be, you could be paying my rent, and and it doesn't matter. And I can just say, oh yeah, I've been paying rent on time. Or I could say, hey, I do pay rent to this person, and it's really, my best friend, that kind of thing. So it's just one of those situations where they just, it's one of those guidelines that they're not bending on right now. So I would just say, if you can pay with check, definitely.
Wow, that's really interesting. I never thought of that, how that would actually affect things, that tiny little detail. And these millennials these days, they don't want to use checkbooks.
No, and even if it's money order, we can verify it. At least we can verify, the transactions coming out, but it's really hard with cash.
Yeah,
So.
gotcha. Okay, well, great advice. Well, I really appreciate all your help, Kim. So I'm hoping that someone calls you to find out how they can purchase this beautiful remodeled 4-bedroom, 4-bath home in Black Diamond Ranch.
Absolutely. Thank you so much for having me, Ruth. I love working with you. She's awesome, you guys. And I appreciate the opportunity. Thank you so
Yes,
much.
thank you. All right. Talk to you soon.
Bye.